Right, so not much has actually happened since the last CUDL. When we did this slide last time, it was a packed list of, Jesus, everything happened. So ETF flows, so Bitcoin ETF inflows have just continued to track up. It had a bit of a dip, which scared everyone, but like I said, it's just people testing the pipework. So when you have a brand new fandangled thing, you know, for institutions to pile money into, people want to test the pipework. They want to see, right, can I move my 100 million in? Yep, that went in, great. Is there an issue getting out? So they'll probably move, 50 million out. And oh, that worked all right. Okay, let's get back in again. So that's normal. It's just like when you're testing out a new wallet or an exchange, you send a little bit over, play around with it, and once you're happy, then you dive all in. So the ETH ETF is having its challenges. So it's hard to sort of get your pulse on what's happening with this. You have on one hand, Bitcoin Jesus, Michael Saylor, going, this is never going to be approved. And he has the best feelers on the planet because he is literally entrenched in this industry. So it's interesting. I don't know what data he's basing his opinion on that. Then you have other people, the other side obviously saying, yes, it's having challenges, but it'll take another year or whatnot. But whether it happens or not, it doesn't really change the bigger picture. We have the US-based spot Bitcoin ETF now, which really is the thing that's going to drive crypto up, really. This is the institutional rally, or the next cycle at least. El Salvador continues to buy Bitcoin every single month. And it's great, we're now seeing a few countries starting to put younger-ish lead, or more switched-on leaders that are doing the drastic things that need doing. So, like we've all heard of a balanced budget. Your parents and your teachers always say, when you're growing up, you're going to have a balanced budget. So if you're earning $2,000 a month, guess what? Your outgoings need to be less than $2,000 a month, right? Well, or actually no, if you're earning $2,000 a month, your outgoings need to be less than your net income, so after tax, etc. So, well, countries don't do that. If a country is earning, say, 2 trillion a year, they'll be spending 4 trillion a year. And so no one's ever heard of a balanced budget in government. But now, El Salvador, we have a young millennial in power who's like all in on Bitcoin. We have Argentina, who's basically just destroying government bureaucracy. He's basically taking a chainsaw and just slicing up government. So I think he's reduced it by like 60% now, and he's still got more departments to go. But Argentina, for the first time I think ever, has a balanced budget. They're getting surpluses. And in 2020, I made a comical, it wasn't comical for me, some people found it funny, but I made a video saying, if I was the dictator of the UK, this is what I would do. And I would probably be the most hated dictator ever, because I would do the things necessary to turn shit around, like have a balanced budget. And unfortunately, if the UK were to have a balanced budget, it would be horrendous. NHS would have to be privatized. You'd have to get rid of, basically, shrink government by 90%. But anyway, Javier in Argentina is doing that. And anyway, there's a knock-on effect there. And Edward Snowden said there's a huge country, so one of the top 5 countries, that is secretly stockpiling huge amounts of Bitcoin. And later this year, they will come public with that. Now, I'm pretty sure it's Russia, right? So when the whole world steals all your funds and basically freezes everything, you need a mechanism or means to transact. So they quickly became one of the world's biggest Bitcoin miners. And it wouldn't surprise me if they're now one of the world's biggest Bitcoin holders. So yeah, hopefully let's add Russia to that. World War III looked like it was about to erupt. I mean, it's just boiling slowly. It seems like the West keeps trying to prod that thing to erupt. But yeah, we'll see what happens there. This is not my field, that's more Willie's field. So maybe in the bar he'll have better insight there. Because yeah, you'll see why later. And then, yeah, recently we found out about the Bitcoin ETF shenanigans. Or recently, it was like Thursday, which is interesting. So for those not familiar with what the shenanigans here, basically there's an off-chain sort of agreement with Coinbase and BlackRock. So, well, not just BlackRock. So basically, these institutions can now effectively naked short Bitcoin. which isn't a good thing. I think short term it would be a bit of a wrinkle. Long term it makes jack all difference. But what happens is basically, let's say BlackRock can go, hey, Brian, from Coinbase, I'd like to borrow loads of Bitcoin because I want to short the shit out of it. Brian will go, okay, we'll give you the Bitcoin, but it's going to cost you a maintenance fee, so you have to pay every day or every week that you're borrowing it, and we need payment in US dollars. So what happens is that BlackRock can borrow Bitcoin, they can short it, they can sell it and dump it, kill the price, and then all they owe Coinbase is US dollars, which BlackRock has, well, they've got basically $10 trillion, so that's not an issue. So they can crash the price and no doubt buy it, buy more at spot. So I think it's just, I was a little bit spooked when I first saw that, but I've been mulling over it for 2 days now, and I think it's, as I said, it won't make a jot of difference in the big picture, but I think it's just a mechanism so that they can gather more Bitcoin from themselves. So do not do any form of leverage trading from now on, because I promise you, we will see a flash sell-off at some point where the candle will just wick down, literally stop everyone out, and BlackRock will have their buy orders at crazy low prices and just hoover it all up. Remember, there's 50 million millionaires on the planet and over 3,000 billionaires on the planet. There isn't enough Bitcoin for all of those people to have one Bitcoin each. So, and when you actually look at what's really floating out there, there's probably only 13 million floating, really. So you have all these billionaires and millionaires. Not all of them can have just one Bitcoin each. So it's going to be a massive, land grab. And I think that's really what all these ETFs are. It's just a land grab. So not much has happened. So let's get back onto the big charts, which is worth going through every couple of months or so. And as traders, it's very easy for all of us to be caught up in the day-to-day bullshit of Twitter and random news events and stuff like that. And I feel slightly frustrated at times because I feel most of my job is saying, calm the fuck down, people. Just literally. People see a news announcement and they start crapping themselves, going, oh my God, shall I sell everything now? I'm like, so yeah. So I think the reason why I'm chilled out at the moment is because I always go back to the big basics. Always go back to the big basics. And the equivalent of big basics with humans, it's like waking up going, am I going to die today? And then the big basics are, do you have oxygen? Yeah. Do you have water? Yeah. Do you have food? Yeah. Is there a big lion about to eat me? Nah. I'm probably going to live today. That's the big basics in living day to day. With crypto, these charts I'm about to show you are the big picture. So let's start with the daddy. The big daddy, hello. Where are there 2 seats? There's 2 seats over here, and I think, yeah, over here. You've missed everything. So, yeah. And now it's break. No. So this is the Fed funds rate. So obviously, I focus a lot on the US charts because when the US sneezes, the world catches Ebola. So this is the US interest rates. And as you can see, we've had, on a linear chart, not the log chart. I should probably start doing the log chart from these days because this looks a lot crazier than what's happening over here. But on a log chart, this is probably the craziest bit. Anyway, we have a pausing of rates. And what have I said for years? When rates pause, stocks melt up, or assets melt up. And what are we seeing right now? Stocks melting up. It's like you could watch a video from a CUDL, I don't know, 3 years ago, and me saying, look, whenever we see these flat tops in rates, stocks melt up. But we all know, hopefully everyone in this room knows, we are about to have an economic recession. So, either back end of this year, sometime 2025. Or maybe even 2026. The market, that age-old saying, the market will remain irrational longer than you can remain solvent. So, but there's shit about to hit the fan, but it could be an Austin Powers steamroller effect where we're like, no! And it could take another 18 months. So anyway, so we have this. So we know whenever we have a sharp jacking up in rates, shit hits the fan. You then layer on unemployment rate. Now, this is the U6 unemployment rate, and we won't go into why this is a bollocks number, but using the Federal Reserve's own website, you can see that every time we have a local low in unemployment rates, we always have a crash. You probably can't see it because of the projector, but these grey sort of columns are economic crashes. So, hiking of rates, local low of unemployment, we have a crash. You then add on inflation to this, and whenever, oh, this projector is shit. But see this green line? We have a hike in inflation at the moment. So these are the three big daddy charts. With 100% track record, folks, back from the 50s onwards. Whenever you see a hiking in interest rates, a hike in inflation, and a local low with unemployment, we always, 100% of the time, see an economic recession. Always. So this is what's coming. We know, like, I think this is the last, up until, I don't know, 2030, we've probably only got another 6 years of really crystal clear-ish clarity on what's going to happen big macro. Because once AI starts putting its racing shoes on and CBDCs start coming out, it's going to really change economics forever. So until that happens, and until we get really, I don't know, 100 million bots starting to add into GDP, yeah, we've got some clarity until then. So shit's going to hit the fan. That's all I'm going to say. Then we look at the 10-year yield. Now, historically, when I say historically, since really 1988 or the 90s onwards, every time we've hit this trend line, we've had a recession. But what's happened now is that we've busted through this trend line, and it looks like it's about to break up. That's not going to happen. This has been completely artificial, but what we do, or what I think is a high probability outcome, is that we're going to see a massive crash in the 10-year yield soon, and it's the same with the 2-year. And the thing that the Fed tends to look at in terms of their economic recession indicators is the 10-year, 2-year spread. And you won't be able to see this on the projector, but this blue stuff is my ghost feed that I did a fair while ago. And I first did this when this chart was down here. There's that first blue line. And I said, we're going to see a big hike in the spread. And once we get into my little holes over here, that's when the whole economy breaks. So it's hard to get your head around T-bills. But typically, the US lends, or they borrow money on 2-year basis and a 10-year basis, typically. So you have the 2-year Treasury bond year and the 10-year. Now, the way that it works is, on the short-term stuff, when the world is worried about, stock market crashes or war and stuff, the 2-year tends to spike up a bit because it's, things are uncertain in the short term, and the 10-year seems to be fine. But then when you start seeing a hike in the 10-year rate, it means investors are getting a bit worried. They're like, wait a minute. Yes, we will borrow, we'll lend you money, United States, but we're a bit iffy about your situation over the 2-year and the 10-year. But when the spread between these two starts rising, or basically when it hits the 0 line, things are broken. But except things got a bit worse this time. We've gotten well past the mean. So things are already broken. It's just that the Federal Reserve is running out of plasters, basically. So yeah, when we get to that hole, shit hits the fan. And when you look at the timeline, that's around 2025. Now, when you look at US debt and US currency supply, or M2, it is it's not a coincidence. It's not even a correlation, it's causation, okay? So you always have to be aware of the 3 C's when you're looking at a chart. Is this a correlation or coincidence, or coincidence, correlation, or causation? And sometimes correlation and causation can be the same thing. So here, a lot of people think, everything's fine. But is it? You look at the red stuff, this is the currency supply. This is growing exponentially. But look at US debt. So we're now in a situation, or really since 1913, since the Federal Reserve was born, we've been in this very, very slow ticking time bomb. But when you look at this chart here from 1991 onwards, this is when basically the US started sniffing coke and heroin and every day, every year. And when you go down that path, it's game over. So all they're in this loop of, I need more heroin, but I need more heroin than the last dose. And eventually they will go, oh no, they won't go cold turkey, they'll just die. And since then, you can see that, you know, when you issue more dollars on the planet, there's more debt. It's mathematics now. Pure math will take over, because we live in a tiny, finite globe, whereas all the math, all the money stuff is growing exponentially, whether it's debt, whether it's the currency supply, whether it's interest repayment, everything's exponential, but we live in a finite globe or finite country. There's only, like in the US, there's only, what, 320 million people. How many of them are productive? I don't know. The stat that keeps getting me is that in 2019, 25% of adult Americans were on antidepressants. That's before COVID. What do you think it is now? 50? I don't know. I can't find that stat anymore. Not an accurate one. So if it's 25% before shit, you know, things went la-la, it's probably more than 50%. And those people are probably not that productive. So.
No, some are very productive.
Temporarily, maybe. I don't know, we'll see. So now there's two different sources. So these two charts show the same thing, but the numbers are slightly different. So whether you want to believe the Federal Reserve or the Bank of America Global Research, is roughly the same thing. This is US interest-only repayments. Interest only on their debt. So here it says 1.1 trillion as of February this year. The Federal Reserve says it's a little bit lower, 1.059 trillion. I think they're splitting hairs here, really. I think the key thing here is that the US is spending over $1 trillion a year on interest-only repayments.
Are they only ever in a state of interest-only repayments?
Sorry?
Are they only ever in a state of interest-only?
It depends. Most of the time, yeah. But the thing is, they never pay back the principal. They just roll on the debt, always. Which is why this chart is important, because now it's $1 trillion. I mean, roughly speaking, the US makes $4 trillion a year in tax receipts and stuff like that. So they're spending 25% of their annual income on interest-only repayments. Yes, Reese?
Does all the weapons they're sending count as income?
Yeah, so this is where GDP is now a bullshit figure, because military spending and military R&D never used to be part of GDP, but it is now. So it's like, oh, I want to find a way to bump up GDP figures. Oh, let's just put military spending in. And who spends the most on their military? The US does. So you can't really, like going back to this, oh no, I haven't got the GDP one out yet. Yeah, you can't really trust that.
So if they're sending weapons to other countries, do those countries...
So yeah.
Do they
So military aid to other nations, that boosts their GDP. So just quickly, for those that are not familiar, the way that whenever you see aid on the papers, like, oh, we sent another 50 billion to the Ukraine, most of the time what happens is we have, I don't know, country over here in trouble, we have America over here, you have the Fed, and then in the same country, let's just say you have the military industrial complex. They go, oh, we're sending $50 billion over in aid, you know, for more weapons, more whatever. It looks great in the papers that we're sending money over here, but no. What happens is this country is now $50 billion in debt. This money never makes it to the other country. What happens is it goes, whee, to the military industrial complex. You know, Lockheed Grumman, McDonnell Douglas, BAE, Serco, all, you know, Bechtel, all these big companies. Because when they see 50 billion in aid, it's like, hey, we'll get you jets and, I don't know, new roads, whatever it may be, bridges. That money just goes straight back into the US economy via the military industrial complex. So US GDP goes up by 50 billion. Ukraine or whatever country, their liability increases by 50 billion. So when we do aid, it's a mix of we're sending, you know, sneaky beaky stuff, but really it's just, the US is just bolstering their GDP.
Is there a chart that shows that against interest-only repayments to get like a health indicator?
I don't know, but it's worth looking into actually. So yeah, that's, you know, some of the shitty economics in the world these days. And yeah, it's not just the US that does that. China does it with Africa. but under a different guise. Now, this is where I normally see a random person on Twitter going, yeah, but Siam, you don't understand. Debt is irrelevant because GDP is booming. Well, I've already mentioned about military spending is now part of, and military R&D is part of GDP. The thing is, whenever I hear that, I'm like, is it really? So here's US GDP. To the layman, just looking at this chart with no context, it looks, Team America, baby. Woohoo. And every country on the planet looks like this in terms of GDP. So the only way you have to understand or put this into context is just overlay debt. So I don't think it's hard to understand that when debt is more than GDP, things are bad, in a nutshell. Yes?
Don't you have to normalise that for inflation? Because,
Yeah.
GDP,
So,
today.
true. And what I should do, so the way to do that, to normalise it for real inflation, is to put US GDP and then USM2. And you'll find that USM2 still outpaces it. So when you basically measure everything against the currency expansion, so M2 or M3, everything is falling pretty much. But yeah, it's not healthy. And then you look at the US budget deficit. I mean, this is the biggest joke ever. So up here, this black line is the 0% line. And every year, the deficit, whenever you hear the word deficit, you see this normally during elections, we're going to reduce the deficit, blah, blah, blah. It's like having a massive fatty saying, look, folks, I know I have 20 Big Macs a day, but I'm going to change. I'm only going to have 18 Big Macs a day from now on. It's not going to really change much, is it? Sorry, I'm really not PC here. So for all the fatties watching this, don't eat Big Macs, I don't know. Sorry. I'm just thinking fat people now. Sorry. No, and the spin-off effects of, it's just a drain on the NHS, it's a drain on, it's quite selfish really, isn't it? Good. Yeah, I hit a new personal best this year with Easter eggs. I hit 32. Yeah, not the little bullshit ones, the proper ones. Yeah, I ate 32, yeah. I've got 2 left in the cupboard.
These fatties looking at you, mate, on you, aren't they?
Well, no, what I do in January, because it comes out in January, I go into a shop with a big trolley, and I go to the Maltesers ones, I go, like a snowplow, fill up the trolley, and then walk out with like 20 to 50 thingies. So, yeah. I'm efficient with my time. I realized for years I was, buying 2 Easter eggs, eating them, and then having to go back to the shops and doing that. So I thought I could save a few hours by just buying them all at once. Anyway, the budget deficit is a joke because, yeah, we had World War III against COVID, so that was obviously bad, and we've had a pullback here. But I promise you, this is only going to increase due to maths. Okay, it's just maths is in the jump seat at the moment. So, yeah. Unless you're Argentina and you just delete the government and then you get into the surplus. But here's the other thing, US budget deficit as a percentage of GDP. This is another way to look at this in more real terms. So over here we had World War II. Pretty bad, right? Here's World War III against that invisible enemy. And yeah, it looks like things are getting better, but this is just a dead cat bounce. Things will continue downwards because now not only are they fighting, real wars, fake wars, whatever, they're also fighting maths now, and you can't beat maths, unfortunately. So, and then US debt as a percentage of GDP is now 120% in the US. So, yeah, this is another way to look at how bad so going back to your, whoever asked over there, this is probably the chart which normalizes it. US debt as a percentage of GDP. So, and don't forget, they're fluffing up that GDP number. So really, it's a lot worse. Now, at this point, there's normally some economists out there going, yeah, but Japan. Because Japan are like, they hit, 100, 150%, percent of the debt to GDP years ago. And the thing is, yes, but Japan. Japan is exactly the answer. So the US has 2 outcomes here. They either die via hyperinflation, or they die via, harikiri, like what happened in Japan. So what happened in Japan in the 90s is they basically went to QE oblivion. They basically just inflated the yen up the yin yang, and the stock market and the property market has never recovered. So if you look at the Japanese stock market, still buggered, and Japanese property has never recovered. So what Japan entered was a 30-year, well, it's going to be more longer, but basically it's a 30-year crash. So not only have they gone, well, they haven't gone sideways, they've gone down for 30 years. To the point where, just look at real estate in Japan. You can buy some big-ass houses for like $50,000 now. And don't forget, they're losing 600,000 Japanese every single year. And that's not because they're running away. That's because they're dying. They're going to be the first civilization or nation to become extinct. Because literally there's more dying than having birth. And the human replacement rate on average is about 0.7 now. So the globe as a whole, we're not replacing the birth rate, decay. And when I say natural decay, that includes war and yeah. So Japan is the thing here. So some people may look at this and go, oh my God, the US is going to crash tomorrow. It's not. They could easily turn in, I think they're more likely to turn into Japan, where things just never recover. The stock market never recovers, and the property market never recovers, especially with the advent of AI, which is hyper deflationary, and it's a good thing. It's bad short term, but it's amazing long term. AI and bipedal robots is very deflationary. And the next CUDL, I'm going to spend a big chunk of the day talking about AI, because not ChatGPT and all that bollocks, but what it means, from sort of 2030 onwards. So, now, I mentioned this in not all of you watch the trading pubs, but James, where's James Dilly? Hey, there he is. He said something a couple of months ago, and he's been living in my head rent-free all that time. And the thing is, so I have a saying, or I have a mantra, or one of my mantras is basically, I regularly interrogate the data set from which I base and form my opinions on, all the time. And there will be things where I'm interrogating myself on a daily basis or a monthly basis. And one of the questions that James said, I think it was on a trading pub, is, Simon, why are you so sure that we will have a drop of interest rates and stim pumps? And I was like, okay, that's interesting. So I sort of froze a bit, or not froze, but it's hard to convey that conviction in a sentence, right? And then I was like, okay, for a week after, I was like, okay, let's go back to the basics, Simon. I did a real deep interrogation. I was waterboarding myself mentally, going, right, why are rates going to drop? Why are we going to stim pump our way out of this? And I just went back to the basics, the big charts, everything I'm showing you right now. And the answer is, it's hard to explain why in a sentence or in 5 minutes. I'm going to spend half an hour going through all these charts, and that's just skimming the surface of the big iceberg, or the iceberg below the surface. But this chart is actual proof. This is proof that we will have a massive cut in interest rates and also stim pumping, because that's all they do. So you can go back to this chart, if we go backwards here by quite a lot, that chart here. Okay, so that's the first one, right? This is US interest rates. What always happens is eventually interest rates go down as fast as they go up, normally down a lot faster. And as interest rates are cutting, what do? They stim pump their way. So they print in whatever fancy way, whether they call it QE or ZIRP, zero interest rate, or NIRP, or negative interest rate policies. They'll give it some sort of acronym, and they're printing. Now, the reason for that is humans, we're just naturally, some humans are just naturally greedy, and politicians and the people in those positions of power will always do the status quo, which is, let's kick the can down the road for another 5 years, print. So, but we finally have proof. And so I trawled through the Federal Reserve Open Market Operations PDF of 2023, so it's a bit late. But what they're doing here, and the Fed are very open what they're about to do, but just no one seems to have picked it up. other than, I think, me. Which also worries me greatly. If am I being an idiot here? But I don't think I am. So here's the context. In 2007, 2008, we had the subprime mortgage collapse, right? And we had a thing called CDOs, so collateralized debt obligations. So what they were doing effectively is taking a whole bunch of junk bonds, or no, shitty properties, junk B-rated stuff, and they're packaging up with some sort of A-rated stuff and then up-rating the whole package. So that's a collateralized debt obligation. So another way to think of it is if you're a chef, like they say in The Big Short, if you're a chef and you're trying to make fish soup, you don't use fresh fish. If you're a dodgy chef, that is, you're like, oh, let's use some of the gone-off fish and just put it in the broth. No one will know. That's what basically a subprime mortgage CDO is. Now, the Fed has shitloads of subprime mortgages on their balance sheet, recent ones and also really horrible ones back in the day. And so they're thinking, things are getting a bit iffy. We need to really start offloading some of these MBSs, mortgage-backed securities. and they said, in this document, they said, we're going to offload, not word for word, but obviously, they're going to sell as many MBSs as they can, and they're going to use the proceeds of that to buy treasury bonds. It's like, wait a minute. So you're going to sell some of this dodgy asset and then buy some of your own debt that you're issuing yourself? Sort of like a reach round of yourself, really. So that's basically what they're going to do. Because what's happening is that they're running out of buyers of US debt. So the way the US raises money is like they go, hey, anyone want to give us a loan? We'll pay you good, APR. But there's less people going, we don't really trust you anymore, the US, because you're fucked. So they're trying to come up with funny ways to, keep that shell game going. And like, yes, everyone's buying US debt. So has anyone heard of the Basel Accords? No? Yeah, okay, couple. So what happens is, if you look at the hierarchy of banks, you have, all the tiny banks, then the big banks, like the primary lenders, Goldman Sachs, JP Morgan, then you have the central banks. But the central banks are not the big boss. The big bad boss is the BIS, so the Bank of International Settlements, based in Basel in Switzerland. It's this big cylindrical building which goes underground, probably half as high as it goes above. And every Sunday, I think it's every Sunday.
That's what you said in the video, like on the horse content, when you discussed this.
Sunday, yeah, it is every Sunday. The central bank leaders, they get together and they talk about this stuff. So every sort of decade, they have a new directive. So you have the Basel I Accords, the Basel II, Basel III. What's coming out in Basel IV is quite silly, really. What they're doing is they're forcing all the central banks around the world and all the other smaller banks to have a high percentage of their balance sheet of US Treasury bonds. They are going to force all the banks across the world to buy. So it's like, here's a gun at your head, you will buy US debt. That's basically what they're doing. So they're trying to come up with new ways to US debt buyers. They're going to force all the banks around the world to just have a high percentage of their AUM in US debt, which is funny. So, and look, they've already started to offload this, by the way, very, very slowly. And the reason why is because two reasons. One, US real estate is at relative highs. So it's a pretty good time to start offloading US real estate. But the real reason, and the leading indicator to this, is US commercial real estate. And now we've been saying this in RT for a while now, that at some point in the future, US commercial real estate is going to fall on its ass and it will bring everything down. Because what tends to happen is you have commercial real estate crashing, that drags residential real estate down with it by default, just due to the lending mechanisms of how it all works. Now, this is an old picture from, I don't know, way back when we first started attacking this bum line, really, or this neckline. And I said, look, there's only two options. We either bounce hard from this, and I said unlikely unless huge QE started soon, unlikely. But realistically, this is going to plop into my hole here. This is the highest probable outcome, in my opinion, not financial advice. None of today's financial advice. So what's happened? Because remember, trading is not about predicting the future. It's coming up with the most probable scenarios the most probable scenarios, and having actions based on each scenario. And Elon Musk has said for about 18 months now that US commercial real estate clangor is about to drop and it's going to be horrendous. Well, it's now dropping. So if we go back a slide, what do you think this chart is going to do soon-ish? There tends to be a 6-month lag. So commercial real estate drops, it drags down resi 6 to 12 months later. So if I'm nobody from Norwich is seeing all this, I'm pretty sure the big boys in the Federal Reserve and Janet Yellen are seeing this going, yeah, now's a pretty good time to start dumping our mortgage-backed securities, getting some cash, then we can YOLO into our own debt. It's a bit like being, let's say I had a business. Let's say I was selling loads of oranges, an orange stand, but I had an unlimited money printing press behind me. It's like me printing my own money, buying my own oranges and going, hey, I'm the biggest orange dealer on the planet. I have the best revenue because you're the only buyer of your own debt. And not only that, you've put a gun to all your friends' heads going, you're going to buy some oranges this year, aren't you? Yeah. So yeah, that's basically what they're doing.
So who's buying the MBSs then? If
they're selling it to the dumb public and other institutions.
Through what channel?
Through open market operations on the secondary market. So, and that's all you'll know. Basically, they'll be selling it to other banks, and then the other banks will probably offload it to the public.
Retirement funds and
Yeah, funds, pension funds are basically the bottom suckers of the world, really. And it's sad, because what happens is that everyone dumps on the pension funds. Because the people that run pension funds are not clever. They're stupid, really. I've met a few pension fund managers. And the more pension fund managers I meet, the more scared I am, because they're like, oh, I've sat here on £1 billion worth of pension funds. I've got to produce a yield, but I don't know what I do. So what do they do? They're like, they spread to other funds. They're just a massive fund of funds. And they're like these old crusty people that don't know what the markets are doing. All they do is they spend their time having lunches with other fund managers, and they're just getting pitched at all day long. That's all they're doing. They're just getting sold to by other fund managers. Hey, just put some of your allocation to us. And unfortunately, the pension funds suck up all of the shitty debt, like in 2007, who sucked up a lot of the subprime mortgage, CDOs, the pension funds, unfortunately. So this is Janet Yellen's piggy bank. So this is the US piggy bank. So this is the US Treasury General Account. And I will read this out for those that haven't seen this. If you have seen this, repetition is the mother of learning, so just wait. This account is the primary operational account of the US Treasury at the Federal Reserve. Virtually all US government disbursements are made from this account. Some tax receipts, primarily individual, and other tax payments made directly to the Treasury are deposited in this account. And it is also used to collect funds from sales of Treasury debt and MBS dumping. So Janet Yellen is in charge of this TGA. And basically what's happening is that she's got a lot of dry powder there. She's ready to start spending. And like, you can see that how it grew pretty, well, actually, this spike here, this was emergency funding. This was, COVID, lockdowns, print, and then just furlough and all that sort of stuff. But we've gone through a round of QT, quantitative tightening. So as in raising rates, trying to cool down inflation, not spend. And so the piggy bank is full. So it hit just under $1 trillion, but she's already spent about 120 billion, like relatively recently. So the funny money is going to start being dished out soon. There's a lot of dry powder. And then it all comes back to the liquidity cycle. All markets are driven by liquidity. It's as simple as that. Literally, that is it. This is really the only chart you need to look at. All markets are driven by liquidity. If liquidity stops and people stop borrowing and lending, guess what? Less things are bought, okay? Because the world revolves around debt, because no one has any money. Everyone is just borrowing debt and rolling over loans to keep kicking the can down the road. So the more that this happens, the more entrenched and ingrained they are in this system, the more tuned into the liquidity cycle you will be. So as an investor, you basically have to look at, okay, what assets are there which are very sensitive to the liquidity cycle? Stocks, bonds, and property, they go up and down as the liquidity cycle goes up and down. What's even more sensitive to this is the Bitcoin market, crypto. So if Bitcoin does something, crypto will follow it. It's the oil tanker of the crypto world. And Bitcoin is the most sensitive asset on the planet to the global liquidity market, which is great for us because this is our crystal ball. So you can superimpose the crypto cycles with this. So long story short, we are at a low in global liquidity because over the last, or basically since COVID and lockdowns, we've gone through QT, haven't we? Quantitative tightening. They're raising rates. They're just trying to starve the economy with liquidity. But everything, mean reversion is in anything cyclical. Because most debt is between 2 to 5 years. But what's happened is that typically big debt like this is normally on a 5-year cycle. But because there's so much uncertainty, that is sort of squeezing down to 2 to 3 years. But long story short, we're at a low. And guess what? We hit, 50, 60 on this index around 2025, 2026. So going back to James's thing, why are you so sure, Siam, that we're going to drop rates and stim pump our way into oblivion, which will then moon our crypto? It's because of the last, 45 minutes of me harking on about all these charts. That is why I'm so convinced. And I'm now 15 minutes over schedule. This is normal, by the way. This is normal. I can never stick to a schedule. Anyway, so yeah, our crystal ball is this chart, folks. I will sell freaking everything at the end of 2025. I'm promising you that. I will dump all my crypto on the market, okay? So this is going to be a cat and mouse game of you all front running me and you front running, everyone's front running each other. So my thing is from Q3, Q4 next year, I'm dumping. But not dump, I'll be taking profits. So it won't be really a dump. Anyway, I'm not going to move the market. It'll be other people. So, and the last time we did that poll, RT as a whole, we have roughly 100 to 150 million pounds worth of buying and selling power as a community. We're a small community, but we're potent. Is that the right word? Yeah. So, yeah. And, if the bull market does what we think, that 100 to 150 million of buying power will probably be like 200 million plus. So, yeah, it is tricky. So this chart is our crystal ball, and my Bitcoin fractal model is the crystal ball as well. Unfortunately, the projector doesn't like colors. So you can't see that this is a green color, that's a red color, and that, it does yellow. Cheers. But where are we now? For years, I've been saying, look, let's just wait to this phase here, folks, because this is where we all get rich. Yeah, and so we've just had the halving. Now it's silly season until Q4 next year. And then we're going to have about a year crash. Yeah, so we've gone through this in detail.